Welcome back, everyone. Really excited for today's deep dive. We're tackling something that, well, keeps a lot of investors up at night, navigating those market storms. So our mission today is basically to pull out the most useful bits from the sources on investment risk mitigation strategies. Think of it as a shortcut, yeah, giving you the key insights to, handle that volatility with a bit more confidence. Okay, let's unpack this.
Absolutely. And it's crucial stuff. These strategies are fundamental. I mean, the core aim here, what the sources really drill down on, is protecting your capital, but also stabilizing returns, building resilience against, well, market swings. It's all about ensuring sustainable growth and ultimately financial security. These aren't just theories, they're practical steps. And the sources kick off with some key ones: diversifying assets, setting stop loss orders, doing your homework, that thorough research bit, and importantly, making sure investments actually fit your own risk tolerance. What's fascinating here is how these initial steps really lay the groundwork. It's the foundation for a more secure financial journey.
That makes sense. So laying the groundwork. You mentioned diversifying. The sources dug into that, right? I remember something about correlations.
Exactly. It's not just about having lots of different types of assets.
Yeah.
That's step one, sure. But the real insight, the pitfall many miss, is diversifying across correlations. Meaning you need assets that, don't all tank or soar at the exact same time. They need to move differently.
Okay, that's a powerful distinction. So it's not just spreading bets, it's spreading them smartly based on how they relate. Beyond that, what about those other foundational things like stop-loss orders? Did the sources offer a fresh angle or warn about common mistakes there?
They definitely did. It wasn't just use stop losses, it was about how. For instance, setting a flat 10% drop as your trigger. That can be a mistake. You risk getting knocked out of a good position just because of short-term noise, especially in choppy market.
Getting whipsawed, yeah.
Precisely. The better approach, highlighted in the research, was considering volatility-adjusted stops. Maybe based on something like the average true range of a stock. It adapts more to the actual market conditions. And with research and risk tolerance, the big theme was ongoing assessment. Markets change. Your feelings about risk might change too. It's not set and forget.
Okay, so those initial steps are dynamic, not static. Got it. But then the material moves on, right? Builds on this foundation. Here's where it gets really interesting, I thought. Things like regular portfolio reviews, hedging techniques, and that crucial long-term planning. These were presented as more like active defenses.
That's a great way to put it. Active defenses, continuous fortifications. If we connect this to the bigger picture, you see how it all fits. These combined approaches, the foundation, plus these ongoing actions, they're designed to really shield investments from those unexpected shocks. It's moving beyond just trying not to lose money, towards actively promoting robust long-term financial health.
And the hedging part, did they give concrete examples? Sometimes that feels a bit abstract.
Yeah, they did, which was helpful. One example was a basic collar strategy. So you'd buy a protected put option that gives you the right to sell at a certain price, limiting your downside.
Yeah.
But to offset the cost of that put, you'd simultaneously sell a call option, which caps your potential upside a bit. It's a trade-off, right? You limit the bad, but also slightly limit the really good. But in volatile times, it can significantly manage risk without totally killing potential gains.
So intelligently shaping the risk, not just avoiding it.
Exactly. It's about building that resilient posture so you can ride out the storms and keep pursuing your goals.
Right. So what does this all mean for you listening in? I think what the sources collectively show is that understanding these strategies and actually using them proactively isn't just about feeling safer. It can genuinely lead to, less wild swings in your portfolio value and potentially better long-term growth. Basically, you have concrete tools now. You can approach the market with hopefully more confidence and foresight.
And maybe that leads to a final thought, something for you to ponder. Beyond these specific tactics and strategies we've discussed, diversification, stops, hedging, all that, how might your own personal financial discipline, sticking to your plan, and your commitment to continuously learning about how markets work, how could those things also act as powerful, ongoing forms of risk mitigation in your own investment journey? We're thinking about how that applies specifically to you.